Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, May 28th, 2025. It's 10:49 a.m. Eastern Time, so I'm starting the video. And more so than an update, I'll do a brief update on the equity markets up front. But I've got what I think is some good stuff and things that I probably should hit on more frequently, and that is we're going to look at some of the trading tips that I've shared over the years. My goal here, I'm not selling trading courses. I'm certainly not selling snake oil. I'm down in the trenches. I've been doing this for years, decades really, trading for a living. And I want everybody. I want to share. I do this because this is my passion. I love this. This is why I started this website, not to make money. And there's just a lot that I've learned over the years. The hard and expensive way. Trading is is a very costly instructor, but that's what I try to do. And the thing is, there's so many nuances to it in a little bit. So what I'm going to do, and I've archived a lot of this, and I've spoken to these things many, many times in the past. But what prompted me to do this now, two things. Number one, Nvidia is reporting tonight, or I should say the stock market is reporting tonight. There's not a single stock out there that I can think of. Used to be Apple was a big one. Apple's no longer doesn't move the market the way it used to. Nvidia is everything. And we all know that it's waiting. It's toggled between being the largest company out there, with Apple, Microsoft, and Nvidia leapfrogging each other recently. So you have that mathematical weighting, and then the psychological impact you can't underestimate. It's again kind of the king, if you will, of all things AI. So they report today, and I'll get to some of my comments at the end of this video. I made a comment to that. If this market's going to go to, if the market's peaked or not, I think will depend on today after NVIDIA reports. And I'm going to comment on that and get more granular when I say that. Because I often say this, it's not the initial reaction when a company reports. There's usually a knee-jerk reaction, kind of like a Fed meeting. I always talk about that. You almost always get a knee-jerk reaction one direction, followed by another reversal in the other direction. Sometimes that's the one that sticks. Sometimes there's one more drop. And again, it takes for the Fed meetings a couple days, for a day or so for the dust to settle and then the market to pick its next direction. Quite often that's the same thing with stocks. And that's not to say sometimes they don't have a big rally after earnings and that's the direction the stock ends up going. Or that's not to say that the inverse doesn't happen. I've seen both. But quite often, I've seen stocks report companies like Nvidia, Amazon, Microsoft, these $3 trillion club companies. They're in $3 trillion. You're playing at the highest level there is in the world, and so they rarely miss expectations, no matter how well they're in the business of guiding expectations to where they need them to be. And so again, it would be unusual to see a big miss. Now it can happen, but what I always say, it's not about the actual numbers; it's about the market's reaction to it. Okay, so that's when you lift up the hood. If you can see everything at once, it's supply and demand that moves a stock. More buyers than sellers, it goes up. More sellers than buyers, it goes down. And that's it. So we'll see what happens today with Nvidia. I'll give you my thoughts and the stock market. And I believe it will set the tone. I'm going to draw a little trend line here on this chart as to the next, whether the market's pretty much peaked out or not. And I'll speak to that one second. Nvidia, the case has been made. It has. We shorted that one off this divergent high as a swing trend trade, and we covered with impunity there on the lows on August 5th, Nvidia and everything else. Looking for that bounce. We pushed up a lot like the stock market, made a marginal new and still divergent high, but Nvidia had broken this long-term trend line that I highlighted. We're on a weekly chart, guys. If I forget to mention, just look up in the upper left-hand corner. It's usually tell you the time frame. You also see a W right there in the weekly. And that is a primary bull market uptrend line off the 2022 lows. Not the secular, just a cyclical trend line for the most recent bull run off the 2022 lows, right? And just like you had divergence there, and you had that was a well into the double-digit drop. It doesn't look like a lot on a log scaling chart like I used. It was a 31% drop. Again, we gamed it with near impunity from high to low, and then this high, we've had several in and outs on it, including covering all short positions back here on April 6th, 7th, whatever the day we bottomed. Leading up to that, it was a scale out and then no more shorts, longs only. And here's where we're at. So this is that, which should be roughly with that DeepSeek gap over there. Recently threw this out as another short reentry there. You have this uptrend line here. So again, this looks to me a stock that has peaked. It had a breakdown and a back test, including a bearish engulfing candle on the weekly chart, just like the indexes had right there. And so I'm still treating that as a topping stick. That's the end of a run, signals a new trend change. Yes, just like the stock market, this thing's pushing the upper limits of what a counter trend bounce, quote unquote, should do, if that's all it is. And again, sometimes, we'll try to fit things in a box and say a counter trend rally. To me, just like the stock market, which I'll get to in a second, any new high, to me, I believe, based on my analysis here on the charts, for the many reasons, including and not limited to the fact it will still be a bigger divergent high and leading the way to a much bigger drop. Again, that's to me. So whether the market, or let's say Nvidia, peaked here or puts in a marginal new high and then reverses, I still maintain the longer term targets that I've had for a long time. But again, these are still my fourth and final target. These go from last year. Remember, we hit T1 back here, right there, and we covered it. That was a 30%. That was, I think, the projections I put when we were back here, if I'm not mistaken. And so we bounced. Then we stayed above the 200s. That was one reason for covering it there. Then we took out the 200s here, where we back tested. We're a hair above them. Again, it's not unusual to see a brief undercut in either way. And again, so there's roughly 70% downside, and if it plays out, again, most likely it's going to play out with this earnings being the catalyst to start the next trend down. T1's already been hit, so it's out of the way. That leaves the next target where there's most likely, if it happens, where I'll consider reversing that position or covering on T2. Again, we'll see what happens. There's a huge thin zone between T2 and T3, so I need to warn of that and talk of my very much what I call openness, that we could go on right through T2 with a little reaction and go straight all the way down to T3. If so, and guys, I do this, just have a plan. My plan may not pan out, and this is just, again, my plans are always flexible and in real time, but that'd be a 62% drop. And again, we're way above that. So I'm not going to spend a lot of time talking about T2 being taken out, because we're still, just to get down to T2, we have to drop 43%. And 99.9, if not 100% of people listening to my voice think that's outright heresy, saying that the most beloved stock in the world can drop that much. But again, and now, just like the stock market, if it goes up, makes a marginal new high, everything's relative to the downside. If you're calling for a drop of 72% in the stock, and from the highs there, and we go up another 10%, then that's a fraction of the total move. But if it goes up much more than 20, 30, 40%, then that's just wrong. And even if those divergences are still intact. But again, I'll comment on that. Let's see what Nvidia does today, and I've got a whole lot more that I think is very relevant for many of you listening to my voice in this video. Just wanted to give that quick update on Nvidia. And then QQQ, the NASDAQ 100, similar thing. I still maintain these targets that I have since last year. T7, the final target, down about 50 plus. I think it's about 55% drop. But again, we hit T1 and T2 back here. Same thing with the S&P 500. You have the long-term targets. We covered everything that morning right there on August 5th lows. Wish I could say I milked every penny up to the top, but no, got a good part of it. Same thing this time around, covered, got a good part of it. I'm often in at the highs on shorts, and often out of those shorts at or near the lows, often back into longs. And this is overshot, but not by a huge amount, where exactly I expected it to go, or not exactly the rough range. You had the where is it, QQQ, Where's my bounce target zone? On one of these here. There it is. I was clicked on the wrong chart. All right, so that was it. So the bounce target zone was pretty wide, but my plan was also not to add on any swing shorts. I'm going to get to that too on the whole using if you're using any leverage inverse ETFs. I spoke to that on this particular rescale in trade or re-entry trade. And so to measure it out from the $500 level, we're up about 4%. And again, so about 4%. And looking at a drop, if again, it's a big assumption. We'll only know if and when we start to get there. Really not till we're all the way there. The downside from here, if T7 is hit, it's going to be about 50%. So that's, again, a relatively very small overshoot. And like I've said repeatedly, as long as we're above those 200s, it increases the odds of a new high. But QQQ, when I look at this weekly chart, this is probably the best way to view it right here. You can see I have a lot of boards, guys. I'm just clicking between boards to try to show you the ones that are relevant. Here's an uptrend line that was broken there. Remember, we put in on this weekly chart a bearish engulfing candle right here. And that was, let's see here. No, okay, guys, there it is. I got out of sync there. It was on a weekly and a daily here up on the upper left-hand corner. There's my weekly chart because I knew it was a bearish engulfing on the weekly on every single index out there. The small caps, the mid caps, the large caps, the Wilshire 5000, the S&P 500, NASDAQ 100. They all printed those bearish engulfings back there. And so far that has marked the top. But again, it's somewhat atypical, the retracement so far of this move, and the fact that we're above the 200-day moving averages and the 40-week, which are the comparable moving averages on the weekly, increases the odds we could punch up through there. But if you see how my lines are drawn, and I've said this often over the years, these things I say, there are no guarantees, but more often than not, let me correct myself, much more often than not, stocks or indexes that break out to new highs with negative divergences, which again, if Nvidia pops us here and we take out the mid-February highs, which so far were the highs, it is, if it happens soon, within the next couple weeks here, it is 100% guaranteed to be just an extension of the existing divergences. And we'll still very much keep those longer term targets in play. It may stop out those of you in that shorter term trade on QQQ. But again, and it's up to you if you want to stop out because we're above that bearish engulfing candle. That was the criteria laid out for those that shorted back then. But again, most of you probably covered there on the first big drop. And again, we may put in the top there, and it doesn't have to be a candlestick reversal pattern, doesn't have to be a bearish engulfing candlestick if it is. There's many types of candlestick reversal patterns. We are below those uptrend lines right there. But again, to me, nothing big happens until we lose the 200s again, right? That's the big thing that we need to do, and it's not too far. So if you want to be the second mouse that gets the cheese, you can wait for a drop back below the 200s. And again, that was told you would be my plan before on the trend position. And so I'll speak to that again in a minute when I get to the using the leverage ETFs. All right, guys, so there's my quick overview. Nothing's changed. The stock market, i.e. Nvidia, reports tonight, and that's going to most likely set the tone as to which way we're going to head. And again, I'm going to speak to the whole after hours thing or not. You can see here, let me turn off all the lines. Earnings, this stock has a history of big moves. I'm going to just circle, you probably can't see it on the chart, these little E's shows when the stock reports. I'm just highlighting, obviously going to report here, 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 here. So you can see Nvidia was in a strong bull trend, bull market back here. We went up after earnings. This one, and this is a pretty good drop. These are all double-digit moves easily. This was kind of a non-event. Stock kind of peaked out sideways, and since then the trend has been no more going up after earnings. That doesn't mean this is not just taking a breather and continuing to the moon, but you can see it kind of it meshes with the charts that the moves have kind of been, maybe priced in. Everything has been priced into Nvidia. We'll see. Again, let's not read too much into it. However, what we want to read, I put a lot more into the chart. So let's see what happens Again, not immediately today after the market closes and they report, not immediately during or after the conference call. You might get some insight there. Here's a clean uptrend line. Remember, I've been wanting to see the bulk of these uptrend lines break on all those market leading stocks, even though we already broke on the indexes. And so that would be a start to see the trend line taken out, and then the 200 simple, really the 200 exponential lies below. That's the one that needs to go, in my opinion. And that was it. So we recently added, there's that deep seek gap back then. Nobody's even talking about it anymore, but that's where we stalled out there. We had shorted right here last time, and then we covered right here recently, and so threw it out as a short when we got up to that deep seek gap again. So there's Nvidia. We'll see what happens tonight. All right, let's move on to what I wanted to cover here and start with the trading tips. Okay, so let me show you where to find these posts. It's been a while because a lot of times I just repeat these things in the videos, but if you click on resources right here on the top menu of the site, it's going to take you to the resource page. If you are new to the site, I check these all the time. Tools of the trade down here is one of my favorites. Let me change the color here so it stands out a little better, make it blue. Earnings calendar, obviously you'll see, of course, Nvidia tonight, and the economic calendar. I check those on during earnings season, of course, on a daily basis. Nvidia is kind of an outlier. It kind of reports away from all the other big fangs and most other companies. But you've turned on the TV or read your news feed, they're reporting. Economic calendar right there. And then right here's what we're going to look at. Educational posts. This is a tag. I use a tagging system on the posts. They're all tagged by categories. You can see that down below the post. In other words, stock market analysis. All the categories up here. You can see this if it has to do with the stock market, fixed income bonds. And so trading tips, we're using the site. And here's the ones I want to cover with you. You can go through these. There's several pages to get to the ones that I'm going to cover today. So I'm going to start with OCO orders, right? This is, again, of all the things I've learned over the years, probably one of the in my opinion, the best things in sliced bread when it comes to trading. What prompted this is somebody last week made a mention. They were a little upset that QQQ, I posted it hit the price target, that first price target on the short-term swing trade, hit T1 in the pre-market session. And if you didn't have a limit order in place, or you weren't in front of your computer, which quite often I'm not, and that's one reason I trade futures too. Futures are trading around the clock, but I'm going to get to all that. So I highly, highly recommend this for two reasons. Number one, before I get to the nitty gritty of all this, is discipline, which is, if you read up on this or if you've been doing this for a while, that's where most traders fail. A lot of them have skill sets. They're able to read charts. They maybe have an intuitive feel of the market or stocks, but it's that discipline they lack. When something's going against them, they second guess their position and they fold and they don't stick with their trading plan. Likewise, and they happens, boom, 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 loss, loss, loss. You get a string of losses. And all of a sudden you're in a winning trade. You have let's say a 30-40% price target on the trade. But first 10% move, you get so excited because you finally see green. What do? You pull the plug on the trade early and the damn thing keeps going. And so if you're in that pattern, letting your losers ride and then cutting your winners short, you're going to lose money in trading. So OCOs, if nothing else, give you that discipline. They are set it and forget it. I'm not going to expand too much on it. I can put links to these down in the this post below, so you can view these posts that I've made. This one goes back to 2018, so obviously it's quite a while ago, 7 years ago. I'm sorry. And I've done this many times throughout. I've covered these OCO orders in many other videos before and since. But again, I'm going to just explain it in a nutshell. An OCO order. They're sometimes known as OCAs. This means one cancels the other, one cancels another. Same exact order. It's just the verbiage used by different brokers, right? And what it consists of, it's pretty simple. You take a trade. And again, you pick your trades. I give trade ideas. If you like them, take them. You may like, but you disagree with the targets, or even sometimes I'm going long something and you're bearish, so you might want to short it. So you might use the same support and resistance levels in my chart. So again, you pick your trade. You enter your trade, and it's very simple. You have 2 orders. You have let me change the color here. Let's just say a long trade. You enter right here, whatever that price is. We'll just say 100. Your price target's 130. So you have a order right here, and you set that. Very important. You want to do, of course, a good to cancel order. Otherwise, if you don't select, a lot of orders will default as a day order. That means it expires at the end of the day. Set a good to cancel, and you set a sell limit at whatever your price target is. Let's say I see the resistance at 130. I'm not going to put my order at 130.00 because that's very obvious. I want to set it a little below. In that case, it might be 129.80 or something, right? It's all relative to the price. You want to be a little below because I'm not going to try to eke out the last couple basis points on a trade, and risk a sudden reversal. When other traders see the same level like me and often sell early. So again, I give you the price targets I give you are the actual support and resistance levels. Make a little adjustment to your order a little below or above that. So there's your target. So let's say 129. Well, I'll just speak just what the level is. Say 130. And then your stop loss, you're going to allow a 3-to-1 RR. So you're going to give a $10 stop loss. So you have a stop loss order at $90, right? And so that's it. So you have a sell order. If your trade is stopped out, it's going to stop you out at 90 if that's hit. And if it goes up to 130, it'll sell you out and book your profit there. And then the OCO part means one will cancel the other. If you don't do it that way, you have 2 standing orders, and you might forget, or your broker might, they might not allow it for your margin capabilities or whatever you have. If that one fills, this one's still open. And so this will automatically cancel whichever one's filled. Okay, so now on that also, what I like to do, and I'm going to get to that here in a second, is I will set and again, I'm going to just, let's say we're doing equities here, right? Futures are similar, but on equities, I will use the sell limit order to allow it to be filled outside of regular trading hours. That's a toggle switch in just about any broker. That means the pre and post market session. And however, I will not do that to my stop loss order, and I'll get to that in a second why. So that's it. Again, I'll include this video if you want to watch it, just to kind of expand on what I just said. Okay, so in those trading tips, you'll find this one. You'll have to scroll back about 5 or 6 pages. And again, it's something I speak to all the time, but maybe not enough. Obviously, if a single person misses a profitable, exit on trade where they were targeting, but they don't realize, that hit. And again, I'm doing this because you won't believe how often my trades are hit to the button. Yeah, it's one thing. If you followed me for a while, sometimes I can't get on my own way on directional calls on something that looks like it's going to bottom or top. But when I'm hitting in the groove and the charts are going well, my trades usually reverse almost to the button on support on targets, especially final targets. Even the initial targets, I get those reactions along the way. So I trade with a degree of precision I just haven't seen elsewhere. And so you got to you can't miss those hits because they happen a lot outside the regular trading session. And again, it's simple. You don't have to be awake. If you have a sell limit order to hit your price target in the after hour session and it's coded that way and it's good to cancel, it will fill if that order is hit. And you'll wake up and oh, good, I hit my price target and the damn thing reversed. And thank God, because I would have missed it if I was awake or sleeping. All right, so considerations for order tickets when trading in volatile markets. Okay, so in a nutshell, and again, I'll post a link to it so I don't get too wordy in this whole video. Something I've covered in the past on numerous occasions. Again, this goes back, when did I post this? 2019. And many times since I've covered this. But in volatile markets, this is what this whole post is about. especially during earnings season or periods of elevated market volatility. My preference is to set my closing orders on a trade for my preferred price target or targets. Sometimes I'll have a predetermined plan, for example, to scale out. Let's say take a third out at T1, a third out at T2. It all depends. So I'll have my price targets, but not my stop loss orders set to be allowed to be filled in the pre and post market session. Again, my logic is here, but it all has to do with my goal on any trade, as yours is to hit your price target, to make a profit and not to lose money. And I explain why. And so these, in a nutshell, in volatile markets, you tend to get those spikes, especially take Nvidia, for example, or look at the market on a Fed day. You're going to get those initial spikes. I want to use that volatility, especially if it's noise. In other words, and by noise, I mean you're going to shoot up and then spike down, and then who knows, maybe you go sideways after that, or ultimately pick a trend. I've learned over the years, and this works very well, much more often than not. I want to take advantage of that volatility, especially if it's in the after-hour session, to exit my position, because quite often, I've seen it dozens and dozens of times, where boom, to the button, my target's hit. Then the damn thing reverses, and thank God, because I'm out, because I had it coded an after-hour session to be filled. However, on the flip side, I don't want to be stopped out. And although, so what I'll do, I don't have my stop loss orders to be filled outside the regular session. And usually they get passed anyways, guys. I won't get too granular here, but you can't do a good to cancel outside regular session hours with a regular stop loss order. Stop loss says if 80 was your stop price, you have to have a stop limit order that says sell me if it hits 80, but only 80. You can't sell me less. Those are the only kind you can use in the after-hour session, limit orders. You can't use regular stop loss orders. Stop loss orders, when it hits 80 or goes below it, it's triggered and then it turns into a market order. They don't let those fill after hours. So, but anyway, so I like to set those orders, my stop loss orders, only to be filled in the regular session. And again, quite often I've seen where there's that post earnings or FOMC noise where something spiked by, would have spiked through my stops, and then everything's normalized next day, and I'm still in the position, and it turned out to go on to hit my price target. So again, you can read up on that, and that's my logic. And again, there's nothing perfect. Sometimes you can see a position go beyond your stop and just keep going. But again, I'll get to the next thing I'm going to cover where I actually pull stops. Let's talk about that. So, okay, so I'll give links to all these. The other one I wanted to cover is extended hours. Okay, and again, I cover a lot in this post, but how to use the extended hours trading session to your advantage. It's pretty much an add-on to what I just talked about with the volatility part, and talking about how I'll use the OCO orders. And then I believe in this one, I'm not even sure. I haven't read through the whole thing because, again, this is old stuff. This is going back to 2018 here as well. And I talk about the advantage of following futures that are trading around the clock and or trades in pre-market, using this analogy of using polarized glasses when you're a boater or a fisherman versus regular lenses. You can just see more what's going on there. And that's why you see a lot of charts posted using futures on the site. So you know what, again, this is going to speak to some of the points that I just mentioned about volatile markets, and also talk about setting the way I set those orders, and on the OCOs, the closing orders. Again, on a short trade, your closing order, your profit target orders, your buy to cover limit order on a short trade. You entered here at 100, you're going to short it down to 80. That's where your buy to cover order, and then you're going to have a stop loss order somewhere above there, $10, 110 or whatever it is. That's your stop loss. So the next one I wanted to get to is this one is another one for those of you that don't use futures, that prefer to, especially when it comes to shorting. Why wouldn't you? Again, if you don't have a futures account, number one, futures are they're highly leveraged, 10 to 1, sometimes more. So there's a lot of leverage there. If you don't know what you're doing, that can really hurt you. And there's traders that don't have a margin account. Maybe they want to shorten an IRA. Maybe it's just as a hedge to long positions, or a pure play. If you have an IRA, you've dedicated to that, for more active trading, that's fine. There's many reasons. And of course, you can't short stocks in an IRA. You can short futures. Most don't know it, but you can't short stocks. And so, but you can buy those inverse ETFs. You can buy the Nvidia short inverse ETF. You can buy the QQQ, all many iterations or variations of it. And so I talk about the pros and cons, and I would encourage you to on that. So again, I'll put links here, but even better is go to the FAQ page under resources, FAQ right here, and then the ETF related questions right there. And then this one right here, and this explains that decay. Really encourage you to understand that it can work to and for and against you, the leverage on an ETF. And in fact, going back to the markets, this time around, as I told you, this would be, it was a much wider scale-in zone than the previous time. Last time around, when we were gaming a bounce right off this low, we gamed a bounce back here. I had a much shorter scale-in zone. So this was a relatively big scale-in zone, and I expected this. It's kind of my cone of, the cone of certainty, or what I'll call the cone of uncertainty, was much wider. And you can see what's happened here. We've stalled out recently. The market hasn't gone up now for weeks. It's in a sideways trading range. It was moving up, had a little bit of grinding there. And so I had said back here on several occasions that PSQ is the non-leveraged short ETF. It's a one-time, meaning it doesn't use leverage. It shorts QQQ. That I said for longer term accounts that I don't have futures, that was and still is my preference to scale in to a short on QQQ. Whereas at times when I believe that the move is going to happen quicker and I have more confidence in it, I'll use the leverage. There's 2 times, QID is twice the short the NASDAQ 100, and then SQQQ is 3 times short. So you pick your poison, as much leverage as you want. But again, when you read up on those explanations of how that can work for or against you, basically, if I suspect what I call a unidirectional trend with a high degree of confidence, this is a unidirectional trend. This is a grind. This is when leverage ETFs will decay. And again, the more leverage it uses and the more volatile the security, this is when you'll lose money. In other words, if you're in QQQ there, you didn't lose anything. You went sideways. But if you were in SQQQ or TQQQ, you did. This is when you can actually outperform, do better than 300% leverage in these strong unidirectional rips and dips. But okay, so again, read up on that, and then you'll see when you might want to opt to incorporate the leveraged ones. The advantage is, if you have X an amount, let's say, again, a non-margin account. Margin, they're going to factor it in, the leverage, but your broker will. And so they're going to reduce the leverage allotment for leverage ETF. So it's a wash, really. But in those non-leverage accounts, like an IRA or whatever, then you're actually, what it allows you to do if you're using SQQ, let's say as a hedge, let's say you're chock full of Amazon, Apple, Nvidia, the usual suspects in the Mag 10, you're bullish and long, but you wanted to hedge up and you take a indirect or a direct hedge. Yeah, you, instead of buying 30,000 a QQQ or shorting 30,000 a QQQ, which you can't really do in an IRA anyways, but let's say you could, you just buy 10,000 of SQQQ. But again, stay away from those in this period. So that's something to read about, understanding that decay, when to use it. And if in doubt, just stay away from them. They're not meant to be long-term holds, but they are, if you get it right, you can actually use that the 30-time leverage to your advantage. Okay, so now I'm going to give you 3 real-world examples. Let me go back to the chart I was just trying to get to on examples, and these are just fresh. These are, again, just 3 of many that I've had. And why, again, if I can convey anything that you take from, this site, lessons learned, it's it's what I'm saying here. If you get confident in trading and your price targets, or in any of the ones that I share, if you're not using the outside regular trading hours, the extended hour session to exit your trades. Now in futures, again, it's how you set your account. If you're a futures trader, you should know this, and that's not tends to be my preference. So on natural gas, let me go to this chart here. Natural gas was one of my best trades last year, most profitable trades. Called this one up from the lows if you were in this one or following it. And again, they're all archived on the site. Many, many videos I covered. We started going long here, buying the divergent lows. We got in on, there were multiple time frames, but this was a longer term chart. This is a weekly chart right here of natural gas futures. It's what we call the continuous futures contract. This is on stockcharts.com. So what that does, it's an EOD, or end of day chart. So they print it every day at the end of the day, update the closing price for it Monday through Friday. And the continuous futures, they just roll and kind of splice the futures contracts in. And you can see my trading style is very clear and apparent on here. Bigger picture. And some just aren't able to ride out these moves, especially in something like natural gas, and they get shaken out. But if you keep your eye on the prize, 223% off that divergent low, 160. By the way, that ended with a divergent high that gave us that divergent low that gave us this 234% rally. Divergent low right there, 205% before all said and done. Divergent low right there. And again, we were maybe not long on every one of these divergent lows, but maybe, and I'm sure on quite a few, probably the majority, because these are old annotations I've had on this chart. That was a divergent high, and this was it. This was, oh no, right here. This is the one I wanted to cover right here. So the price target. So going back here, and in dozens of videos, I started out when I was first throwing the trade idea out here. Remember, natural gas was down about $1.70. I was calling for a $5 long-term final price target. $5. I was saying just shy of the $5 level. And then I started zeroing in. When we got going here, I started zeroing in, and I identified it to be specifically at $4.90, my price target. Again, and talked about in many of the videos, and even you can see it on the site. And what you notice here, remember, this is the continuous futures contract end of day chart. It does not show that target was hit on a Sunday evening. In fact, if you guys followed me for a while, you don't get many weekend posts from me. I shut down. My weekends are mine, but I do, Sunday evening, because I'm a futures trader. I have a little app on my phone, investing.com, best things to slice bread, to follow the futures. I also did a video on that, how to configure it and use it. If you have any questions, let me know, and I'll be glad to share that with you, so you can see what's going on. And so when the futures pick back up Sunday, I'll usually just see what's going on there. And of course, again, there's a lot of takeaways here. I had my sell limit order in at 490. And that was hit. The 490 line's right there, just under the $5. It looks as if it never got hit, and it did. In fact, this was that post right here. There's the 490 target, and the reversal was huge. So we hit it for about a 200% profit from the early 2024 lows to the button. That was the reversal. The reverse order got filled, reversed me from long to short, and then called natural gas down. And again, that's all she wrote. And you can see going back to that trade there, it's hard to see such a large chart, but that was the right there. We peaked there. And again, it happened in Sunday evening. They only reflect Monday through Friday trades. So that there was the next day down here, and that's a pretty big give back all the way down to 450. So if you didn't have a buy to cover order in, you wouldn't have got out. You would have still been, if you were still waiting for 490, 490 never came. It came to you once. It came in the Sunday evening trade, hit it button, and that's it. So you would have, fallen all the way back to $3, given back nearly half your profits. But again, we were able to short that because of that. So that's one. Probably it's a great example, but again, it's one in recent memory. And looking at that. Again, if you want access to this post, just let me know. I'll give you a link here. So there was the exit point. Again, that was, I believe, posted that. Yep, that was Sunday night right there. Got it out to you, which I rarely do. And again, said it wouldn't be reflected yet. And it never did get reflected because, again, they print end of day, and they didn't show the Sunday. They don't show the Sunday abbreviated trading session right there. The rest of the charts were just the previous charts calling it up to the, there it is, previous charts calling up to that 490 target. All right, so that's one example. A couple more here. More recently, we had GDX, second price target hit. And again, this is just in recent memory. Remember, I will cover a little bit, always cover a little bit below, above on a short trade. And you can see, it's hard to see here, but that's what these are white candles. So in the pre-market session, this was got that out to you at 8:40 a.m. That was time you should have been filled, unless you're awake in front of your computer. But again, and if you are, you would have got out. Now we go to GDX. That was on May 15th, and you can see here, GDX. Now those trades, I can't turn them back on. I can only turn on the most recent trades, today's or last night's. And so again, when you look at this chart, if you did not have a good to cancel order, or you were not awake to do it then, set outside regular trading session, you would have missed that fill and given back. It's rallied off that point, actually off the support level there. It rallied about 13%. Or you would maybe you wanted to game that bounce and go long. You would have missed out. You would have lost the profits on the short, and you would have missed the profits on the long reversing there. So if you want an update on it now, I've put this line right here. It's at this previous peak right now, resistance, and it's got some divergence. So we're probably going to take another leg down and then go on to hit this trend line would be my guess. All right. So then you probably have a little uptrend line you could draw there. So there's your update on GDX. That wasn't the point of this video. The point was to show you again, that's two recent examples. Again, there's dozens and dozens over time. And then the last one, even more recent, and this is the one somebody commented and they seemed a little upset because the trade hit. But again, I've talked about this many times and I can't say it in every single video, the benefits of setting those orders to fill outside regular trading session. This is QQQ right there. T1 was to be covered right above that 502.88 level right there. And if you zoom in here, looks like we reversed shy of the target, but in reality, here's the post that morning, and this is the one that drew that comment that I wanted to reply to. And guys, I welcome all kinds of feedback. And so listen, I'm not in any way, shape, or form upset that I had to say this again. There's a lot of, again, little nuances, and most of these nuances in trading, these little tips I cover in these videos, because there's just too much. But that's it. That's a perfect tag at T1. Again, if you had a standing buy to cover limit order, you would have been filled and or been able to reverse and game the bounce if that's what you wanted to do. As I've showed you on many of my trades, the vast majority, upon the initial tag of each target, a reaction is likely. And that's even here on the FAQ page. If you go to trading related questions, why do some trades list multiple price targets? And that's all explained here. And again, some traders like to game those bounces. Obviously, it only makes sense that you're going to have a higher possibility or probability hitting the first target as time goes on. The probability lessens, but there's more profit potential. And again, how you trade it's up to you, depending on your outlook, everything else. So again, you might want to read up on that one as well. Last but not least, let's just go to some of the recent replies. I caught up yesterday. I wasn't really into the replies. And Monday went offshore fishing, about 200 miles round trip, over 70 miles off the coast of Florida. So it was a whole day thing, and that just takes it out of you, especially when it's not flat seas, which it wasn't. And spent yesterday an hour cleaning fish. So I got back to some of the comments today. That one's not I didn't need to reply. It was just a commentary. Good commentary. Appreciate the feedback there. And I did see, I'm very aware of the Japanese long bond yields kind of getting out of control. Let's see here. Just going backwards in time. There were a couple I wanted to just share real quick with the group. Oh yeah. All right, Kevin. Thank you. Yeah, on the CW trade yesterday, obviously that was a typo. I commonly make typos, especially between long and short, because I'm a very flexible trader. To me, some traders are always long, long, long. Some are, very few are short only. And so yes, I corrected that in the post above. Wheat was an objective long entry on the there it is on the back test, not a short entry. I corrected it in the post typo, but not of the chart. It's harder to pull that chart out and put a new one in. Yeah, stop loss on wheat. Yeah, that depends on the targets. I'll get to that on the next update on wheat. But yeah, if you want to keep it short-term tight stops, give it a little bit below that trend line. If it fails that back test, then that would be a tight stop. Otherwise, I have very long-term targets. And as I mentioned, wheat is at long-term support on the weekly chart. I didn't mean to kind of get off on a tangent here. This is a new reply. I didn't see that before. Remember, we're buying wheat at a very long-term secular bull market uptrend line. So on that, you might want to give it a little more room. Let's say plus or minus 10%, because the upside is high double digits, possibly triple-digit upside on wheat. Yeah, and here's another one. This is under the post from yesterday, or no, yeah, yesterday's post with the NDX and Russell 2000 charts. Great comment by Kevin here, who says this is not political. And guys, please, we can speak about the president, the White House policies, as long as it's relevant to trading. Let's not keep, anything that's inflammatory, keep it off. Yeah, I don't like this president. I like him, and I didn't like the last president. Let's just say that. I think we've had a shitty run for a while. Don't agree with some. Obviously, both of them. I agree with some of their politics, not others. But keep that off. But keep it relevant to the market. So, and I agree. This is not a political statement. I agree. Trump is a bag of wind. I agree with that. Who's going to build a wall? I guarantee you're going to build a wall, and I'm going to make Mexico pay for it. I mean, who says that shit? Anyways, whatever. Let's just talk about what relative to the markets regarding the tariffs. So he says, when he sets a date for tariffs, when the day gets near, he pushes that date back and the market rockets higher. Good strategy, go long just before the next deadline on tariffs. All bark, no bite. In fact, yes, I agree with that, and I've spoken to that in quite a few of the recent videos. Trump has about zero credibility now on what he says. And I, personally, and this is what I replied, I'm dumbfounded on how and why both humans and algos place even a single trade when he tweets something out about the tariffs. Because we know, as I predicted he would before, he cows down, he talks a big talk, then pauses, and they even have a name for it. They call it the taco trade. That's in the media. Trump always chickens out. That's what it stands for in relation to tariff threats. However, I will say it doesn't seem to matter because at least recently, the market ratchets down when he announces new tariffs. Just remember a week ago when we hit T1, that was remember, we took advantage. There's another example. He tweeted out he was going to up the tariffs on the EU. Futures dropped. We hit our first target on that short trade and pre-market. Again, that's where the comment, someone was upset that it was hit there and it wasn't in the regular session. I can't control that. That's why I'm doing this video talking about the benefits. But so far, every time that he does that, it's been able to recoup all, if not then some, of the losses once he cows back down again. So that is the current thing. And again, it'll be the boy who cries wolf. Sooner or later, people aren't going to take him serious. I'm surprised it hasn't happened yet. I'm surprised there's still reactions as there was last week when he upped the tariffs on the EU and then, of course, cowed down and it regained all that. That's all noise, in my opinion. Now, so today, the stock market and AI bubble reports earnings. That's Nvidia, and will single-handedly most likely determine whether or not the stock market has or soon will peak on or around the mid-February highs or not. So that's my reply there. In other words, and I've been saying this for a while now, tune out the noise. The noise is Trump's tweets, his rhetoric, economic reports. Yeah, you can take those more on face value. So keep an eye on those. And we know eventually you can read up on it. I've seen some good articles kind of where tariffs are probably going to end up. We all know Trump's strategy, talk about 200, 150% tariff, some ridiculous number, and it'll end up with a 10% tariff on China. They said most likely maybe 25% on select things. All right, there's a question about a potential inverse formation on the head and shoulders pattern. I'll just end the video here, just talking about that on the Russell 2000. In my opinion, no. Inverse head and shoulders patterns, for those of you not familiar, and I would encourage to look it up, they're known as bottoming patterns. And so what you want to look for them is in the bottom of a trend. So when I go here to a weekly chart, this is IWM weekly. Let me just turn everything off here. So you can clearly see what takes the shape of an IHS, inverse head and shoulders pattern. You have a neckline right here, a left shoulder, a head, and a potential right shoulder. However, again, they're not, this would be, I wouldn't even call it a continuation pattern because we had a correction, but bigger picture is the NASDAQ 100 is in a secular bull market and has been off the 2009 lows, even a longer terms, like everything else, secular bull market. Even this is still a cyclical bull market here. I'll turn back all my lines. But to me, the fact that we're in this big, and I've talked about it quite a bit recently, this big sideways trading range, this purple box here, a potential double top pattern. That's another thing you can look up. A double top pattern, when you have two equal highs, you can recognize the base of the pattern, which is right here. And then this is a measured target. To compute the measured target, take the distance of the double top pattern, that basing top right there. A sell signal comes on a breakdown below the pattern. There's your measured target. I've shared this before. Double top measured target, if that plays out. Now, the sell signal comes on a break below the pattern, the purple box there, which will also coincide with this longer term potential uptrend line. I call it potential because I only have two reactions so far. But this is the level I put a big weighting on. And what I can tell you definitively is the small caps have taken out their 200 days. They fell hard. They hit that support level at 171. They bounce, and they're back testing the 200s. They are the most sensitive to interest rates. So these treasuries are still, remember guys, the market's had a little reprieve. I said at the end of the video here, but I have to hit on IEF. Not mere coincidence. The morning that we hit T2 on that QQQ short trade was right here. Yields ticked up, and they punched into my orange zone. It was ever so brief. We popped up after that, but we're still flirting with that orange zone. And remember, that's where the stock market starts to take note, really starts to take note of rising yields. We also have the 30-year bond still, again, within spitting distance of all-time highs. I'll get into bonds in another video, but this is my weekly chart. And so any move above the recent highs there takes us to new multi-year, possibly even multi-decade highs in treasury yields. And so the market is, it could certainly go down from here. I could make a case for that, but I can also make a case we break out there. All I can tell you is I'm not laying a bet right now on treasuries. I'm watching this because the market will, I would be really surprised if we see a solid and sustained breakout. Anything more than a brief pop through that fails on yields in the stock market doesn't take note there, especially the small caps. And also watch the 10-year as well. The 10-year has a little more room to break out to new multi-year highs. The 30-year is pushing it right now. All right, guys, I'm going to wrap the video up. I know it's long-winded. I'm going to run out midday, do one errand. I'll be back tonight. Like I said, I usually don't comment after hours when a big company reports like this. If it's any big move in either direction, if I have any thoughts, I'll share them. If not, we'll pick this up tomorrow. And again, I'll be back this afternoon. I'll try to get to any questions that you have. All right, this has been Randy Finney with the right side of the chart. Have a great day.